Hello everyone, Heinrich here with World Smart Mastery channel. In today's episode, we're going to be talking about psychological trading mistakes that a lot of investors make, be you a brand new investor or a seasoned investor. If you're new to this channel, we want to welcome you. Please hit on that subscribe button and don't forget to smash on that like button. In the trading world, having a sound and composed psychology is very, very essential towards your success or failure in the trading world. Mastering your mind and thoughts is very essential towards your success or failure. Cognitive bias is a tendency that leads our thinking away from a correct judgment. In today's topic, I'm going to discuss 3 essential psychological trading mistakes. Psychological trading mistake number 1, it's the fear of missing out. It is called FOMO. This affects so many traders, the fear of losing out. We are right now in a tech world that we join all kinds of trading platforms, and people with little or no experience, they are there pushing out ticker symbols and stocks to buy, and you, with all that is going on, you fall into that mistake and buying a bunch of those shares, and you end up losing a bunch of money. If one of the best traders like Charlie Munger and Warren Buffett missed out on Google and Amazon when the stock or the IPO were just initiated, then what about you? You will miss out on some, but the fear of missing out, that is what is essential, and that might lose you a lot of money in the long run. To address the fear of losing out, FOMO, some of the solutions is to stay away from those chat rooms. Again, I'm not telling you to not join groups that you guys discuss trading strategy and stuff, but don't rely too much on those chat rooms and on those social media platforms that people with little or no experience, they shoot out ticker symbols and companies that they're buying tomorrow. And with you, with little or no experience, and you haven't done your homework, you jump into those IPOs or into those ticker symbols and you end up losing money. Also, get more education on some of the stocks that you intend to buy. Do more research, look at the news, what's going on those stocks, look at their market caps, look at the volume of those stocks, and see how they have been performing for a period of time, say between 3 to 5 years. And the final solution for the fear of missing out is to have a plan. You need to have an entry and an exit plan. You don't just trade for the sake of trading, but you need to have a plan. And that plan should entail your risk tolerance, respect to what is the right time for you to get out if things are not going as you have planned. Psychological trading mistake number 2 is revenge trading. Have you ever experienced where you spend over $2,000 in buying a share, and 2 or 3 days from the day you bought the share, it's worth, say, $300. We blow up everything because of a loss. If you keep it up, you'll get it crushed. You have to be strategic with the way you invest your money. Do not invest based on anger and based on failures that you have had in the past. Learn to document your failures and your successes, because that's what will build you and to minimize and mitigate the risk going forward. Solutions to revenge trading: try to take very small positions. Diversify your portfolio. Don't just go out there and buy Tesla because Tesla is trading. Don't just go out there and buy Amazon because Amazon is trading. Don't just go out there and buy Walmart because Walmart is trading. But have a very diversified portfolio will minimize your risk and will help you not to lose a bunch of your money in case one sector or one company take a dive. Also, focus on long term. A bunch of new investors and some of us that have even been investing for over 3 to 5 years, we sometimes want to make quick money. If you think you're getting into the stock market to make quick money, then it's a long road for you. Focus on long-term goals. Make sure you think in the long run, because that is how the principle of compound interest and averaging plays. Look in the long run, 3, 5, 10, 20, even 40 years from today. And continuous investment, that is what matters. Remember, you will win some and you will lose some. Don't expect to make money on every trade. Personally, I lose on some of my trades and I make gains on some of my trades. But the best way that I analyze my results is on a quarterly and on a yearly basis to see if I'm making money or I'm losing money. But I don't pay too much attention on daily losses or gains, because that's gonna drive you nuts. Psychological trading mistake number 3 is a gambler's fallacy. A lot of people take the trading market like a casino. A trading market is not a casino. If you take it as a casino, there's a high probability you're going to lose your money. You have to do your homework, you have to do research, and you have to minimize your risk. Take for instance, you flip a coin. There is a 50% chance that it will either be a head or a tail. Actual numbers can deviate at any time, but the probability that the next chance, it's totally independent of the prior. So there is no time that because the stock is going up today, there is a probability that it will go up tomorrow. There isn't any probability that it will happen the same way that it happened yesterday or the day before. But at the same time, you have to do your due diligence in order to take a position that will be less risky and that will minimize your risk. Remember, the stock market is not for the weak and emotional people. It's rather unfortunate. A guy 2 weeks ago committed suicide based on a negative account that he saw on his Robinhood account. I'll ask on you all traders to invest on facts and not on emotions. To recap, we're talking about psychological trading mistakes that we traders will do on a daily basis. Number 1, the fear of missing out. Remember, you can't get it all. You will get some and you will lose on some. So remember, do it at your pace and have a strategy. Psychological trading mistake number 2, revenge trading. Don't get emotional and don't get angry when you lose on a trade and try to put an even bigger position because you made a loss on that trade. There is a high probability you will lose some more money. And psychological trading mistake number 3, a gambler's fallacy. Don't take the stock market as a casino, because there is a high probability you will lose all your hard-earned money. Trade with facts and not with emotions. Make sure you do your homework and figure out your risk tolerance respect to where you can cut your losses. As always, thank you for watching. We really do appreciate you. If you're new to this channel, don't forget to subscribe and also smash on that like button. We will see you on the next video. Ciao.